Hello and welcome back. If you are new here, my name is Jessica Abella and I am a tax professional in the Seattle area. If you are a small business owner, a solo entrepreneur, or even if you have employees and you're looking to save for retirement and reduce your tax bill, you have more options than just your traditional IRA or Roth IRA. Today, we're going to talk through some of the major retirement plan choices that you might want to consider, either a SEP, a simple, or a 401k. And we've got the 2025 limits to discuss. First, let's chat about SEP IRAs. SEP, self-employed pension, it's still a favorite for a lot of small business owners. It's nice because it tends to have very low administration costs. They're very simple, despite the fact that we're going to talk about simple IRAs in a moment. Don't get that confused. But they are very straightforward to start and to fund. The limit that you can put into a SEP IRA is $70,000 or a percentage around 20% of the profit of your business. This is one that we can't tell you exactly what your maximum contribution is until tax time. When we've gotten all of your deductions incorporated, then we can do that. The nice thing is that the SEP IRA can be funded all the way until the due date of your tax returns. When we're preparing your 2025 tax return, you'll have until April 15th, 2026 to fund the SEP IRA. Or if an extension is filed, you'll have all the way until October 15th, 2026 to make that 2025 contribution and take that tax deduction. SEPs are a fantastic tool. One thing to keep in mind with SEPs is that if you have employees, you have to contribute the same percentage for them as you contribute for yourself. It's not a great option if you have employees. The simple IRA is a good option in between the SEP IRA and the 401k for smaller employers. If you have less than 100 employees, you can do a simple IRA. The employees can defer some of their salary in, like you may be familiar with if you've had a 401k in the past. Employees can only contribute up to $16,500, so it's a lower limit than a 401k for the employee. There are some additional provisions for doing catch-up contributions if you're over age 50, and an additional catch-up provision if you're over age 60. Those are things to keep in mind if you have employees in those age ranges, but that applies to the employee contribution part, not your portion. As the employer with a simple IRA, you either need to match 3% of their actual contributions or 2% for all employees. If you have an employee that doesn't participate at all and you chose the 2% option, you have to contribute for that employee even though they did not participate in the plan. An advantage to the simple IRA is a lower administrative burden. It's usually a lower cost plan to administer. Those contribution limits are lower, especially if you're a higher earner and you are trying to put more money into your own retirement plan. This may not be the way to go. The 401ks have become much more approachable over the last few years. First, there is a credit available to help pay not only the monthly administration costs of these 401ks, but also to help you pay for the employee match on these plans over the first 5 years of the plan. 401ks are much more accessible now. If you have employees, note that you needed to have your 401k established before October 1st of 2025 in order to have a 2025 plan. If you are just a sole owner and you don't have any employees, you do still have more time to do that 401k setup, initial setup. For the solo 401k, or really if you have employees, keep in mind that for yourself, you can contribute much more to a 401k than you could to that simple IRA. As an employee, you can contribute up to $23,500. There are those catch-up contributions similar to the simple IRA. To keep those in mind, but the employer contribution can be up to $70,000. Well, total between employee and employer contributions, the max is that $70,000 that we saw on the SEP. The math is just different in how you get there. Keep in mind again, if you have employees, how you approach that employer match portion has to be similar between you and your employees. You can't just dump a bunch of money into your own 401k without also contributing to the employees. 401ks do also have additional administration and additional costs as they become larger. Just to be aware of that, there's an extra form that has to be filed every year for the 401k once it becomes larger. So hopefully this has been helpful. Definitely work together with your tax professional and your financial advisor. The correct plan is going to depend on if you have employees and what your goals are. Those plans that have lower administration costs may be fantastic for you and where you are in your business and what your goals are. But the 401k may be fantastic for you, again, depending on how many employees you have and what your goals are and how much you want to be able to set aside for retirement. So hopefully this was helpful. Let me know if you have additional questions. Please click like if this was helpful, share it with a friend, subscribe if you'd like to be notified of future videos, and have a fantastic rest of your day.